One of the things the ultra wealthy do is they don't try and time the market. They invest. They invest like they're the owner, right? They don't let the market somewhat dictate their investments, right? So they don't try and time the markets. Think about it over the long term, I think, is real key for them.
Hey everyone, welcome back to another episode of Wealth Strategy Secrets of the Ultra Wealthy. Today, we are sitting down with someone who spent over 2 decades helping family offices and institutional investors design sophisticated portfolios across private equity, hedge funds, private credit, and real assets. Mike Alexander recently joined the Pantheon team as our alternative investments portfolio and capital markets director. And he brings a rare insider's view on how the ultra wealthy actually think about diversification, due diligence, and building resilient portfolios that perform through every market cycle. In this conversation, we dive deep into the lessons he's learned managing over billions in family office assets and what truly matters when evaluating funds and sponsors, and how individual investors can apply those same principles to elevate their own wealth strategy. Get ready to rethink everything you know about asset allocation, risk, and simplicity. Mike, welcome to the show.
Thanks, Dave. Thanks for having me.
You bet, Mike. Well, welcome to the show. Welcome to the Pantheon team, and appreciate your time today. And, really we wanted to get to know you a little bit more and really kind of talk about some of your background and expertise in the private equity and family office space, and how investors can really leverage that into some of their own thinking, some of their own strategies to really propel their own wealth. So with that said, tell us a little bit about your origin story and how you got to where you are today.
Sure. So I guess I'll start off where life began for me in the corporate world. I started out working for a very large insurance company back in the mid 80s. And really, before I got started on investing, I started off with the insurance company on the operations side and on the investment operations. And I really think that was a really good learning lesson for me to kind of learn, teamwork and basic accountability for your work. So started off there and worked my way up within the insurance company, finally over to the investing side after a few years. And was able to really cut my teeth on alternative investments at the insurance company, where we were basically using the insurance general account to make hedge fund investments. So I did that for a period of time and had an opportunity to move over from kind of the large institutional world over to the family office side, which to me sounded really interesting and entrepreneurial. So I did. I jumped from the big corporate world over to a multifamily office where, I went from, working with 50, 60 people down to working with 5, 6 people. And, if the printer needed paper, I'd stop and put paper in the printer. And basically, if I didn't have a secretary to type my memos, I had to type my own memos. I mean, it was really kind of roll up your sleeve and do the work yourself. And at the multifamily office, I was really tasked with bringing in an investment process, formalizing an investment process. So I did. I brought in a due diligence process in terms of conducting due diligence on managers, basically everything from asset allocation procedures to formalizing a formalized investment policy statement for investors, bringing in a system to capture data, things like that. So, Dave, when I first started at the multifamily office, we had about 50 million under management in assets. And, fast forward 10, 12 years after that, we had over $1 billion in assets under management. So it was a very successful run at that time. And we had clients, family office clients, as small as, several $1 million to a very large behemoth client that had, multiple billions in money. So we really kind of spread the gamut in terms of the type of clients we worked with. And obviously the multi-billion-dollar client required a lot of time and a lot of effort. And so I was really, moved over and focused more on that particular client for their portfolio allocation and investing. So worked at the multifamily for approximately 14 years. And then we brought on near the end of my term there, we had just brought on a very large very large Japanese family office, and they wanted to set up a U.S. corporate entity to make investments out of. And family office I was working for asked me to move over and essentially run that company for the family. So before joining you, the past 5 years, I was working for this family, Japanese family, and essentially running the company. I built them basically a 70-30 portfolio, 70% hedge funds, 30% private illiquid lockup type vehicles. No public securities, no public equities or fixed income, strictly alternatives. And it was a great run. I built them a portfolio, and today it's still in existence. And it's turning out decent performance for them, and they're very happy. Found you not too long ago, and you seem to have a very, very interesting process over what you're doing here at Pantheon, and came over and to join you to try and take what I've learned over the last couple of decades and move it down to an individual investor level versus this large family office. I think to me, an important thing that I want to do is basically take what I've learned over the last 20 some years and apply it to more people than just a few, than just a dozen families. I want to be able to implement these portfolio strategies to the mass amount of single family or single investors that are out there that want this type of exposure. So I'll cut off there and kind of let you ask any questions.
Yeah, no, thanks for that. Thanks for that, Mike. And you just really nailed our mission there, where it's so important to really help people uncover the strategies that a lot of the ultra wealthy just know because they have access, they have teams, and it's really, frankly, quite a very opaque world, and it's very opaque on purpose. And you can't really uncover these type of things, right? And so that's part of our mission with this show, with our business, to try to help others, uncover some of these different strategies that can really be life-changing, frankly, to their wealth and how they live their lives and creating legacy. So with that, what do you think are some of the key lessons from that world of billion-dollar family offices and institutional investments? How are some of those lessons really that you've learned that you can bring back into the community for Pantheon today?
So I think, Dave, one of the most important lessons I learned over the last 20 years that the typical 60-40 portfolio doesn't really work through market cycles. It just doesn't work. What we've built and what I've been taught from an asset allocation perspective, which is really key, is that you almost have to embrace an endowment model for investing, which instead of a 60-40 portfolio of equities and fixed income, you want 60-80% of your portfolio in alternative investments, things like private equity, private credit, real estate, tax efficient strategies, things like that, especially and real assets as well, which help protect against inflation. And I think building something like that into an existing traditional portfolio was a key lesson that I had learned from the institutional side. The other thing too is due diligence. Conducting proper due diligence on a fund is really critical, and I think one of the things I govern my due diligence by is what I call the 3 Ps. It's pedigree, process, and it's performance. So when I go and look at a new fund, first thing I'm looking at is who's the manager, who's it run by, what's their pedigree, what's their background. The other thing that I look at, which is just as important, if not more, is process, because the fund manager or the sponsor has to be able to explain their process well enough for me to get comfortable with the investment, because in turn I take that information that they tell me and I simplify that to the individual investor or to the client. So it's real important that process is well explained. And then finally, performance, right? Performance. Very curious in terms of how these funds performed over various market cycles. And if they're newer funds and they don't have that historical performance, then it's really critical to understand in the short term how that fund has performed over the near term, and can the sponsor or the portfolio manager explain to me, why did this fund perform so well when the market was down, or vice versa, right? I mean, that needs to be explained, because all of that gets translated back to the individual investor in the end. So those are some of the key things I think I've learned over my term as an investor.
Yeah, so let's unpack due diligence a little bit, right? Because I think, this is one of the things that, we are constantly refining. I don't think there's one silver bullet, right? And, just kind of bringing a whole rigor to that process is one of the things that, we like to do it for investors, because frankly, it can be a full-time job, really trying to know that. And you might not necessarily know what to look for or where to look for certain data points about a fund manager or a particular project, a particular market, or some things like that. And I know you even co-authored a book on due diligence, Mike. So talk to us about, a few of the key points in addition to those three Ps that you really look for when diligencing a new investment.
Sure. So really, the due diligence is really break it down into two pieces. One is the quantitative side of due diligence, right? You're running metrics on performance, or you're breaking down balance sheets and P&L statements, or the other part of that is the qualitative side, which I think I spend a lot more time on the qualitative side, and probably most other allocators do as well. But really kind of breaking down the qualitative piece on the due diligence is key, right? So it's really a combination of, speaking to the sponsor or the portfolio manager, understanding their strategy, going through the legal documents, right? Understanding the legal documents, understanding any any special treatments that other investors may get if there are side letters. Going through a lot of that. Also, one thing that's equally important on the diligence side is the operational due diligence, or as we commonly refer to it as ODD. And ODD has just taken on a whole new look these days with things like cybersecurity now, AI. There's just so many things now that people on the ODD side have to look at when they're conducting due diligence on managers. And all of that really has to get rolled up into a template that is presented to the client at the end of the day. And it has to be simplified, and it could be 4 weeks, it could be 6 weeks. Some institutions take 2 months to do due diligence, and you take all of that work and all of that information, and you roll it up into a 2-page exec summary, and you present that to the client. That's to me, there's a lot that goes into that. It's a really critical piece to the whole overall investment process.
Yeah, let's talk about simplicity for a second, right? Because I think, this world of, the financial services industry as a whole, people can basically drown in data. You can turn on CNBC or Bloomberg or pick your choice, and, we're constantly inundated with data. Or if you're trying to do, due diligence on a particular manager, as you said, there's just so many data points and different things to consider. So when you're working with clients and really talking about portfolio allocation and just overall strategy of a investment policy statement, how do you really try to simplify things for them?
So again, kind of going back to that, one of those 3 Ps, the second P, process, it's critical, because that I have to be able to take that process that was explained to me and translate that to the client, right? So it's really being able to take a complex strategy, say something like investing in secondaries or a multi-strategy fund on the hedge fund side, take something that's complicated like that, and simplify it to the client, and translate it more or less so that they fully understand the strategy, and you have to also explain to them how that strategy fits into their existing portfolio. That's also critical, as so they can understand where it fits, and also being able to explain to them how that strategy should perform over various market cycles, right? Because not one strategy is perfect all the time. And finally, how do you map that? How do you map that strategy or that asset to where they are currently today, right? Do they need something that's tax efficient? Do they need something for income? Do they need something for growth? How does that all fit into what their needs are? So it's really, that second P that I keep referring to. It's really taking that process and being able to simplify and explain that to the client and how
Yeah.
that fits.
Yep, couldn't agree more. I mean, anytime you can really create clarity in terms of certainty, where people are going in terms of their investments, their financial future, that creates confidence, right? And that's really what people are paying for. People are looking for that certainty, and there's certainly not much certainty in the markets right now. It's constantly in turmoil, but it's kind of interesting because when I look back, I mean, I can almost remember a year when there hasn't been, uncertainty and turmoil and something, whether it's, geopolitical events, something happening economically, certain sectors or things, what the Fed is doing, right? There's always something. And I think it's also really important for people to kind of take some of that data, number one, with a grain of salt. Number two, take the data from sources that you really trust and then are going to be actionable for you. Because there's a lot of folks out there that are basically into fear mongering, right? Because they have an agenda. They may be trying to push gold or Bitcoin or certain things, right? Is you need to sell everything, and we need to put everything into gold, right?
Right.
That's kind of the narrative, like right now on the debasement trade. So, what are your thoughts around just how do you really weed through all of this different information to really make the best decisions for your strategy?
And I mean, there's a whole source of like to your point, there's a ton of information out there. I tend to rely on a few sources. One are the large investment consultant houses, the Cambridge of the world, the Allburns of the world. I mean, they put out podcasts like what we're doing right now. They talk about all the different hot topics that are out there, in terms of the crypto markets, the private credit markets, things like that, and they just have a ton of resources that they throw on these different strategies. And so they're one data point, right? They're an interesting data point to use. The other thing too is just relying a lot on my own Rolodex of people that I know. I get invited to certain investment communities where 20 to 30 allocators like myself will go into a room and we talk about what are the best ideas are you seeing what are you seeing? What do you like? What don't you like? We'll typically bring in someone from, a large institution to talk to us about, maybe the secondary market or private equity or what's going on in hedge funds, things like that. So there's that big information sharing as well. That's another source of information. And of course, just whatever industry rags I can get my hands on, I read, right? So there's just a ton of information out there in terms of how best to source ideas. But yeah, at times it feels like, you try and drink water off a fire hose sometimes, but then you just have to kind of pick your battles in terms of, what you read and what you don't read.
Yeah, for sure. I also think that, sometimes people ask me the question, what is the biggest missing link for most investors? And I would actually pinpoint that is having a lack of a strategy. Because if you don't have a strategy, you're really just kind of investing maybe deal by deal, or you're getting information maybe from an advisor who's just looking at things, really one dimensionally. But that's one of the things, right? The benefit of, working inside of a family office, the first thing you do is create your investment policy statement, which is a comprehensive strategy in terms of, not only your, all of your objectives, your goals, right? What's important to you now. It ties to your investor DNA, your risk profile, all these different things. So I think you can kind of really protect yourself, from yourself, and stay in line and not get caught in some of these emotional cycles as well. So Mike, also, you talked about an endowment model a little bit, right? And then you talked about the 60-40 split. So I want to just kind of, bring this back up a second for investors out there, right? And I think, part of the biggest systemic issue we have in this country is frankly lack of financial education, basically in the world, right? But U.S. specifically, right? Most people think, regardless of what your net worth is, the things that people have been taught are, investing in your company 401k, and they're giving you a, 2-3% match. So that must be free money. So I must do that, right? Or yes, this 60-40 type split, or giving all of your capital to a financial advisor or some type of plan, right, in equities markets, but not really understanding all of the things to really consider about. First of all, that if those are qualified funds, you can't access them until you're 59 and a half. No one ever really talks about private markets, right? Because it's just kind of it's a very unique, sector. There's less information on it than public markets. So I think it leaves people a little bit, confused and trying to figure out a strategy. So talk to us a little bit about, what some of the popular endowment models look like in terms of allocation, and how you see family offices allocate, just at kind of a high level to give people more of a sense of, investing outside public equities.
I mean, the first thing with the family office and the use of the endowment model, I mean, you have to remember too that for these families, liquidity is not an issue at this point, right? They have a time horizon that's could be 5, could be 10, it could be 15 years before they actually need the money. And versus a typical 401k investor is saying, well, I'm putting this money aside. I'm gonna need it at some point down the road, but I really don't have many options in terms of how I can allocate it. Where a family has a ton of options, right? They can, kind of going back to that endowment model, they're going to kind of divide that allocation up between growth, which would be more PE or private equity. They also are looking for current income streams, which would be private credit or some type of direct lending strategy. They could be looking at some type of a value add strategy, like a real estate investment or real estate fund where they put their money in. And then, they also have kind of that 5 or 10% allocation into venture capital as well. And then, the rest of it, the smaller parts are spread across more of the typical traditional equities and fixed income. But it's really for them, the key is the time horizon, right? They could be either building money for their lifestyle over the next 5 or 10 years, or it could be a generational thing, right? They could be building wealth for the kids or the kids' children, which aren't even born yet, right? So they could be looking out 10, 15, 20 years and even greater for some of these investments. So the key with a lot of this investment model is, at least on the private equity, private credit side, is the pacing of when these investments start to distribute capital and start to mature, right? So what they're doing is they'll go into fund 2, say private equity fund 2, and they'll put the money into fund. The capital's called over a couple of years, and the money goes into fund 2. And then as the money starts to come back in years, maybe 3, 4, and 5, they're taking that money and they're reinvesting it into Fund 3 and eventually into Fund 4 and eventually into Fund 5. So they're pacing their level of distributions, which is really, really smart, because what's happening to a lot of investors today is they have a lot of illiquidity mismatch with their pacing schedule, because in the private equity markets today, the distributions over the last 12 to 18 months haven't come back as fast as people have hoped for. And so a lot of these investors are stuck in these investment vehicles, which has created this market for the secondaries, because in the secondary market, funds come in like a Blackstone or a Hamilton Lane. They'll come in and they'll create these funds, and they'll buy out these investors. They'll give them liquidity. They'll get them out of these private equity funds, and they can go in and they can buy these funds. They can go in and buy these LPs out at a discount, which is nice. And they're already buying into an investment that's in year 5, 6, or 7, right? They've cut out the J curve with this type of investing, which is nice as well. So yeah, the families, a lot of the endowment model, they're driven around this type of strategy, this type of time horizon, which makes it very unique and nice for them. And it's the same type of institutional type investing that you and I can offer, Pantheon investors. We can get them into these type thinking along these lines, right? We can have them think along how you should be thinking about making your next investment, with money from your previous investment that's now in the distribution mode. We should really be steering them towards that type of a model and make them, continue to generate growth and generate wealth for them and their future generation.
Yeah, that's such a great point, and really brings out one of the really awesome features in Pantheon Wealth OS, our new software product, where you can actually do tax forecasting. You can do income level forecasting, because it's so interesting. I think so many people forget about certain things. You may have a liquidity event of an asset of a certain business, and then you've got a lot of tax liability in a certain year, whereas that's not the best year, right? That you want to, have the most amount of income, right? So timing the income distributions, like you said, and kind of phasing it in terms of your tax strategy as well, can really optimize, your overall really velocity of capital and efficiency of capital as well. One of the core philosophies is really teaching clients here to think like the ultra wealthy. So from your perspective, what are a few key mindset or strategy shifts that separate the ultra wealthy from everyone else?
I think it's one of the things the ultra wealthy do is they don't try and time the market. They invest. They invest like they're the owner, right? They don't let the market somewhat dictate their investments, right? So they don't try and time the markets. Think about it over the long term, I think, is real key for them in terms of how they think. Again, the other thing too is, and we've been sort of touching base on this, is that being tax aware, structuring your investments to be tax sensitive. I think a lot of that plays an important role on how they think. We kind of mentioned upon the pacing of the maturity schedule. All of that, I think that is so important for them and kind of differentiates what they do and how they generate wealth, for not only for themselves, but for the next generation.
Hey, it's Dave Wolcott here. Let me ask you something. Are you tired of the same old financial advice that leaves you spinning your wheels? If you're ready to discover the real secrets the ultra wealthy use to build unstoppable wealth, then I've got something just for you. My new book, The Holistic Wealth Strategy, is your ticket to learning the proven strategies that the top 1% don't want you to know. This book isn't just about money. It's about building a life of purpose, freedom, and lasting impact. And I want to give you a free copy. Visit holisticwealthstrategy.com and get yours today. It's time to level up your financial game and create the future you deserve.
Yeah, for sure. So, what do you think about basically the economic cycle that we're in, really kind of navigating the end of the year here and positioning into 2026? Again, there's fear mongering. There's always, on one hand, you can always find some pundit that says, "Hey, there's a big correction that's due," and then you can find someone else that says, "No, absolutely not." Right? With people with great expertise and things. So, what are your thoughts really on kind of where we are in the cycle? What does 2026 look like? Should people be, a little bearish or bullish right now?
Yeah, that's a great question. I wish I had a crystal ball, but I don't. I think, politics aside, I think if you look at the current administration, they are business friendly. I think that they're also looking to do some additional fiscal spending over the next 12 to 18 months, along with they're thinking additional rate cuts. So again, what I'm getting at is all of this is good for small businesses, right? So small businesses should be okay over the next 12 to 18 months. I don't see any major correction in the markets. I think there's too much strength underlying the fundamentals in the market. So with that being said, I like private credit. I think private credit is not going away. I know every time you open up the journal, there's a headline that it's a bubble. But why is Blackstone just putting in $500 million into a fund for private credit? So I think so. Private credit, because banks aren't going to change their lending tactics at all. So the small businesses are going to continue to go towards the private markets for capital. I don't think that changes. The second thing is, I mentioned already, secondary market. I think there's a big problem. Well, not a problem, but there's an issue with investors not being able to get liquidity out of their private equity investments that they should have gotten by now. So they want liquidity. Secondary market is something that's really, really hot right now and interesting to get into. And then the third thing would be real assets, right? With inflation not going away, I think the new inflation target is probably 3, not 2% anymore. So I think 3% is here to stay. And in order to combat that, real assets is something that is a good play for part of your portfolio in terms of inflation protection. And I mean, that's sort of what I see over the next 12 to 18 months. Although, anything can happen, right? We're in some very unusual markets right now.
Yeah, for sure. Well, if you could give just one piece of advice to the audience about how they could accelerate their wealth trajectory, what would it be?
I would say, look, don't try and do it yourself. I would say, we offer a virtual family office service. I would say call us on that because, that's an opportunity for an individual investor to not only, utilize your service and my service, but we can help them get to fractional help in terms of taxes, estate planning, investments, you name it. We can get help in all those different areas. It's too hard to try and solve all of these problems by yourself. I think the more people you have working for you and around you, I think the better off you're going to be long term.
Yeah. Appreciate that, Mike. And what we will do for the audience is actually put Mike's calendar link and contact information into the show notes. So if you wanted to have a complimentary free call as a portfolio assessment or to connect, we're going to extend that to our audience today because we appreciate our loyal listeners. So Mike, thanks so much for joining us and really appreciate your insights and, for today and moving forward with the team as well. Really grateful to have you on the team. And for the audience out there, thanks again for tuning in, and we'll see you on the next one.
Thanks, Dave.
Thanks for listening to this episode of Wealth Strategy Secrets. If you'd like to get a free copy of the book, go to holisticwealthstrategy.com. That's holisticwealthstrategy.com. If you'd like to learn more about upcoming opportunities at Pantheon, please visit pantheoninvest.com. That's pantheoninvest.com.